Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm pleased to have Gabriel Caillaux joining us today. Gabe is co-president at General Atlantic, where he also serves as head of EMEA, also known as Europe, Middle East, and Africa, and he's global head of climate. Since joining the firm in 2004, Gabe has helped lead General Atlantic's global business and climate investment strategy. GA manages approximately $114 billion as of the end of June. Gabe, I'm so glad you were able to join us today. Thank you.
Thanks, Alex. Great to be here.
Let's go back to the early days. How did you first become interested in investing, private equity, technology, and were there any formative experiences or early influences that helped shape your perspective?
Yeah, great. I'll go way back because I've always kind of been a little bit of a hustler. Even when I was in high school and in college in France, I would ship over basketball memorabilia from the US and hustle people in France to make a little bit of an earning. So I'd always had the hustler side in me, but really the investing side happened because I started my career in investment banking at Merrill Lynch during the telecom boom and dot-com boom of 99 to 2001. Which was a fascinating period, right? We capitalized so many companies, whether it was debt and equity, for this massive internet expansion. Of course, we all know how that finished. But it was a big learning moment for me, mostly because what I discovered is what I really liked spending my time on investing behind was trends of tomorrow, right? And at the time, when I started then wanting to leave banking and go into investing, I had the chance to meet all the buyout firms. And as you'll probably remember, Alex, back then, what they really did was value investing and real deal structuring was the alpha that they brought to the market. And that's something that I didn't find really fascinating. What I was really looking for was who's investing capital in themes that I think will carry growth for decades. And I did a little bit of research and a completely anecdotal story. My office mate at the time at Merrill Lynch walked in one day and said, "Oh, I have a friend who just quit this firm called General Atlantic." I'd actually never heard of GA. And back then, there was no real Google search. So I went to the GA website and I had our research team at Merrill look up news flow on GA. And I loved what I read. It was about globalization. It was about digitization of the economy. It was about all these things that I saw happening in my banking days. And so I cold called GA. I picked up the phone, called him and said, "Hey, I heard you just lost an associate. I'd love to work for you guys." And that led to a set of interviews 2 days later. I think they made me an offer a week later. I quit my job the following day. And that was 21 years ago. So I think what really happened was I went from being a hustler to having really this view of if I could invest my own money, I would always put it behind long-term trends that I think will carry growth. And I found GA through almost serendipitous ways.
You've had a long career in leadership. So reflecting on that career, what lessons about leadership have you found most valuable, especially anything that might sound counterintuitive or unconventional?
I think it's one of the biggest pleasure of my job is I get to meet great entrepreneurs and great leaders. And I think there's some very kind of unique characteristics you see in some of these leaders. And of course, they're always bright. They're always hardworking. They're always innovative. They always have this. I think the biggest characteristic that I see in great leaders is the ability to attract and motivate talent. The people that have impressed me the most are those that are, of course, they're all bright. They're all great. But the ones that really succeed and really help and really scale are those that surround themselves with bright people. And we see that not only in our portfolio, I see it in private equity, I see it in our own firm, right? We're kind of constantly on the lookout for the next great investor, constantly on the lookout for the next person that's going to advance our program. And I think that's a sign of leadership, which I think so often gets undervalued, right? There's sometimes a little bit of a cult of the entrepreneur or the cult of the leader. I would tell you that it's something we've learned to look around and really try to assess the whole value of a team. And that's, to me, that's really what stands out.
How has your personal investment philosophy and perhaps your approach to company building evolved over time? And what advice would you give to aspiring leaders?
So over time, what I've noticed, so I've been now at GA for 21 years, which is a really long period of time. It's interesting how the market has evolved. I'd tell you 20 years ago, you would get rewarded for finding a new great company, right? You could be the first person at a new company. And what you realize then is you'd build a relationship with an entrepreneur, you'd help them build their business, but you were really backing an entrepreneur and you were backing yourself to find a new trend or a new great business. I think our market has evolved super quickly. and in a healthy way, right? Which is today, yes, it's more intermediated and it's harder to find that next new company, be the only one to speak to them. The flip side of that is the way we really drive alpha, the way we really win an entrepreneur to trust us to become their partner is by convincing them that we can help them build their company. And so we've built a huge amount of tools internally to help our entrepreneurs do this. It's everything from build your management team, build your Salesforce effectiveness, your go-to-market strategy, your IT infrastructure, get the right capital structure, like all these things. And what you find is the great entrepreneurs, kind of like what I mentioned on wanting to attract the best talent, the great entrepreneurs, they are so hungry for our help. They realize that if they can leverage any piece of help, they can grow their business faster, better, more healthy, more sustainably. We see exactly the same thing, and I've seen this in my leadership role at GA, which is the business that continues to change massively. I joined the firm, we probably had less than $1 billion of assets under management, and a busy year was we'd invest 250 million. I think a busy year in Europe was we'd invest 50 million, and now we manage 115 billion of assets. Europe is a 30 billion AUM type of business. A busy year in Europe is 2.5 billion of deals, right? So as we've evolved, and what you learn is if you keep your head down as a leader and not take external input, not take external help, eventually you'll run out of road, right? So what I've learned to do over time is be extremely hungry for advice, be extremely hungry for input, and be really humble about what you don't know. I've done that. I've had the chance of working with some of the most senior people in Europe, and my chairman in Europe, a French colleague called Henri de Castres, ran AXA, ran the Bilderberg Foundation. I can't tell you the number of times I call him, even with the most mundane questions. But that's also symptomatic of wanting to leverage everyone else's mistakes, everyone else's learning. So, long-winded way of saying, I think you have to constantly be curious, constantly be asking yourself what you could do better, and be really open to external input.
And it sounds like part of it is also recognizing that you don't know everything. And the more really smart, successful people you surround yourself with, the more obvious that becomes.
It doesn't happen often that you stumble on a problem that no one's had to deal with before. So why try to crack it yourself when you can take everyone's input and then choose your path?
You mentioned earlier that you're of French origin, but I know you also grew up spending time across the world in Germany, Japan, and the US. Has this experience had any impact on your attitude towards investing?
Huge impact. First of all, I loved growing up around the world. I think it opens your mind to the cultural differences that you see everywhere. And I absolutely, as part of landing at GA, one of the big motivators was the global platform and the global ambition GA has. And I think one of the things I've brought to the firm over time is constantly think of new markets. For us, what that's been is when I took over our business in EMEA, the Middle East was really not even an afterthought. We've seen that kind of bubble up as an opportunity set. And 10 years ago, we decided to set our eyes on it when a lot of our competitors only viewed that as a fundraising market rather than a real investment opportunity. So that's been a key part of how I've thought about it. I think it's a key part of how we run our firm, frankly. And what I mean by that is it's taken us we're completely global, as you know. Of the growth equity portfolio, 40% is in the US, 25% is Europe. The rest of the balance is developing markets around the world, Brazil, Southeast Asia, India, and even China. And what we found out as we've built that infrastructure is you have to localize as much as you can. Of course, you want to leverage your global platform. Of course, you want to take advantage of the infrastructure you build, but the origination capability, the deal winning capability, the relationship building capability, that has to be hyper localized. And I don't think you can sense the importance of that without traveling, without opening your mind up to this. So the easy way of thinking about it is you do not win a deal in India the same way you win a deal in Italy. And actually, you don't win a deal in Italy the same way you win a deal in the UK. And so that's been a huge part of our hypothesis and philosophy of investing. And I've definitely benefited from traveling my whole life.
What do you feel like has been one of your most educational investments from your career thus far?
Investors always like talking about their good deals. And of course, I could tell you a lot about some good deals we've done and what I learned from those. I would tell you, you learn so much more from the challenging ones and working hard to get money back. I think the hardest one is partnership risk. Is in a minority program like ours, 80% of our deals were in partnership with an entrepreneur or with a strategic corporate person or with another private equity firm. And I think the ones where we struggle the most is when we chose the wrong partner. And shame on us for choosing the wrong partner, shame on them for being bad partners. But you learn so much from having to keep pushing your own agenda, the right agenda for your investors, the right agenda for our investment program, even if you have a tricky partner. And I've had a few of those situations over the years. I won't name them in case they listen to the podcast, but that's to me is by far the biggest lesson, and it's one that carries forward, right? Because next time you meet, next time you do a partnership deal, in the back of your mind, you absolutely carry the scars and the learnings from whatever previous partner and whatever had gone wrong.
How do you feel private equity markets have changed and matured over the past few decades?
Massively, right? So the market continues to evolve quickly, and it's unsurprising. You look at the growth we've been through the last several years and even the last decade. It's tremendous amount of growth. By the way, I think it'll keep growing. I think the private equity product for entrepreneurs and for investors in many ways is a superior product to the public markets. In a way, we have no choice but to evolve because our market is growing and our market is evolving quickly. And I think the way we always look at it is, as we run our GA business, is we really have three stakeholders that we worry about. Of course, there's the investor, and our commitment to the investor is we want to drive the best performance possible for you. There's the commitment we make to entrepreneurs, which is the other stakeholder we have. And to them, we want to have the best product that helps you grow your business. We want to have a brand that represents your values. We want to be the best partner possible. And then, of course, there's the investors, right? There's my team. And for them, we need to have the capital to make the investments they want to. We want to have a platform that helps them win and an execution capability. And so on each of those dimensions, our industry is moving massively. For LPs, of course, performance is key, but you have LPs that want diversification. You have LPs that want to be able to choose different markets, different risk return profiles. So you've seen some of people in our industry go from single product to very broad product sets. For the entrepreneur, it's gone from passive investing to more active investing. I think it'll be positive change, but I think some funds will struggle if they can't invest in that transformation.
You just alluded to this, but if we look at private markets through the eyes of the entrepreneur, why might private markets be more attractive than public markets?
In the growth area, I'll tell you the first basis is I don't believe you can invest in a growth company if you're really worried about monthly performance. Of course, you have to track monthly performance, but if you're really a growth investor, what you care about is the 5-year outcome. And investing in growth means you've got to take somewhat a longer horizon in the way you assess the risk return you're buying into. And that's the starting point of our discussion with all entrepreneurs is if you're growing your company 30 or 40%, we acknowledge it's not going to be linear. It's very rare to grow linearly at that kind of pace. We acknowledge you're going to have a good and a bad quarter, but don't worry, we're going to be here to help you throughout that period of time. So I tell you the starting point to stay private longer, and it's a theme, and you see it in the numbers, right? Fewer and fewer companies are going public. They're staying private longer. I think the fundamental reason behind that is it is easier to build a growth business if you have patient investors and you don't have to worry about volatile public markets because you miss your earnings by a decimal. The second part is, as an entrepreneur, what do you get from your investor, right? From your public investor, you get a quarterly call, and that's about it. If you choose GA as your partner, I alluded to this earlier, we have built an enormous amount of infrastructure, our entrepreneurs, with whatever challenges they see in growth. And because we're so focused on technology-enabled growth across very specific themes, you can imagine the lessons we learn through our portfolio, the knowledge sharing we have across entrepreneurs, the experience we have in certain issues is massive. And so when you're an entrepreneur and you're in this growth period, to be able to rely on GA's people, to be able to rely on our network, to be able to rely on our past entrepreneurs and current entrepreneurs, I think that is of enormous value.
Long ago, it used to be that once a company reached a certain scale, they had to go to the public markets just for funding and support. And that's no longer the case as well.
That's true. And if you look at it, this is well documented, but you see, what is it? Private equity markets are somewhere around 10 trillion globally. I think that's a number that people feel pretty good about. Public markets in the equity side are still 125 trillion, right? So we're still a fraction of what the public markets are, but we're growing very quickly, and the public markets are seeing companies delist or list later. So I think it's absolutely a trend. Does that mean it's easy to fund companies at the very, very large scale? Probably not, right? There's still a limit to what you can get done in privates. but that limit is growing quickly. So to your point, in my experience, our average deal 20 years ago was a $50 million deal for a minority stake. Now our average deal is a $250 million deal. Exactly the same technology, same structure, same everything. It's just companies are getting bigger and staying private for longer. I think that limit will get continually is a moving post, right? I think our markets continue to grow and it's going to get challenged. And you're seeing it right now in this boom of capital going into AI. I actually don't have the number at the tip of my fingers, but the amount of capital going into the large language models right now is tens and dozens of billions, right? And that is all for the time being been privately financed. So you can see that these markets still have a way to go.
Why wouldn't an entrepreneur just partner with whoever offers the highest price?
That was a theme that was prevalent during 2020 and 2021. So what was really disconcerting about the boom times of 2021, of course, valuations were challenging and very expensive. Of course, markets were constantly racing up and to the right. I would tell you the biggest challenge we saw was exactly what you just mentioned, which is there was a flow of capital into our markets where I don't want to call it reckless underwrite, but it was definitely quick underwrite. And entrepreneurs were faced with the option of saying, okay, hold on, I'm going to have to do 45 days of diligence by GA and get their product, and they're going to nibble on price to get the best deal possible. Or I take the 1 week deal and just get on with it. And not only was it a quicker deal, believe it or not, they were getting more capital there because you had certain players that we've all heard of and I won't name that would overcapitalize companies to fit the size of their fund, which is a disservice to all entrepreneurs. I think that that's gone away completely. The market has learned very quickly that you should not be picking easiest capital to build your company intelligently because it's created all sorts of issues. First of all, a lot of entrepreneurs has realized they chose the wrong partner because those people don't help, don't add value, don't even show up to their boards. Second of all, usually it's created a capital structure now that needs to be readjusted. If you raise money at way too high of a price and you need to capitalize yourself again, you're in a terrible situation to attract new capital, right? You've typically actually created an issue. So I don't know why entrepreneurs chose it. I think it was because it was easy and simple. I think they've learned their lesson and that part of the market has gone away, at least for the time being. And I hope for a really long time. I think in our discussions, and I look at the last 3 years of momentum in our business, entrepreneurs have become really intelligent about who they invite into their capital structure, CEOs and entrepreneurs. They've learned from that lesson. I think it means brand value. I mentioned this earlier. The brand value of your firm really matters.
And it's probably a good match because if they have a long-term focus, they'd be much more interested in the trajectory of the growth of their business rather than the price they receive today.
Oh, 100%. One of the toughest parts of our discussions with entrepreneurs is usually we want to buy as much of the company as we can, and the entrepreneur wants to sell as little as he can. And that's a really healthy dynamic we have. So, if there were a typical GA deal, I'd tell you we buy somewhere around a third of a company or a quarter of a company. But we always try to get as much as we can, and the entrepreneur wants to sell off as little as he can. And the fundamental reason behind that is they have belief that there's more value to get in the future. And the reason they'll let us buy in is because they think we can help change the direction of the firm and make it even stronger.
And those two pressures are probably related, meaning you want to own more because they want to sell less.
That's exactly right. Probably. Oh, and we want to own more because the argument we give against that is to say, well, the more I own, the harder I'm going to work. Don't tell entrepreneurs that's actually not true, because even if we own a little, we're going to work very hard.
Would you tell us about GA's core principles, especially the belief that technology will ultimately disrupt every part of the economy and that entrepreneurship and innovation are global?
Yeah. So those are principles that we've held now for over 20 years. And when you think about it, we built our entire investment program around those two core hypotheses, which is one, technology will absolutely impact every element of the global economy, whether that's at the consumer end or whether that's the enterprise end. That feels like an absolutely obvious statement today because of what we've all experienced, right? I can tell you 25 years ago, it was a lot less popular as a statement, but we were seeing it happen with the early days of software. And since then, we've been through several kind of technology cycles, right? There was the internet cycle, of course, then there was the mobile internet cycle, then there was the cloud cycle, then there was the sharing economy, now we have AI. And every time what it teaches us is that statement that technology is deeply impactful everywhere is growing stronger. The second statement that at the time was also not an obvious one was we convinced ourselves, and we're still convinced, that innovation and entrepreneurship is a completely global game. And you're seeing that today, right? I think today you see it in the weight of our portfolio, which is now 60% outside of the US. You see it in the number of company formations. You see it in the number of unicorns. You see it in the global fundraising. I can tell you back 25 years ago, innovation was really the luxury of maybe the West Coast of the US and a bit of China. And so when I started GA 21 years ago in Europe, I had a lot of people rolling their eyes saying, well, why would you waste your time looking for innovation in Europe? It's not going to work. That is no longer the case, right? What you're seeing is entrepreneurship is absolutely booming everywhere, and you can track it. We're seeing it now in the Middle East, right? I think that's a market no one thought would become investable for growth equity for a while. We did 2 deals last year. They're both performing extremely well. The entrepreneurs are the same quality as entrepreneurs you'd find everywhere else in the world. And you've got a young and dynamic population that's completely digital. So those 2 foundations of our investment program are ones that we built the entire global process around. The way we originate, the way we manage our teams, the way we underwrite our deals. And we think that we're in the early innings. So it's been true for 20 years. We think it's going to be true for many, many years still.
And all of that despite this reversal towards deglobalization.
100%. And I don't want to sound dismissive of that risk, because it's obviously something we track very carefully. And I think there's not a day you don't have some piece of news around this. What we see in the digital markets is there's been no slowdown. I think the physical markets might slow with tariffs and some of the China decoupling and so on. We haven't really seen that in digital. We do see China obviously has its own digital ecosystem, and the rest of the world has its digital ecosystem. We're still seeing growth in flows between both blocks. We think that's going to continue. It also hasn't impacted our global portfolio. It's still today the portfolio is almost 90 billion of value. That the average growth rate there is over 30%, right? So the fundamental growth is still there. So we haven't seen deglobalization yet as a headwind. It's actually created certain opportunities, right? Our Southeast Asia business, we think, becomes a net beneficiary. We've seen a lot of capital flow into India. So if you take a look at India and how that market, the public markets as well, the privates, have gained momentum in the last several quarters, it's been really powerful. So it's something that we worry about, but so far hasn't really been an impediment to our strategy.
Well, GA has managed through a transition from its early days decades ago as a family office to a multi-product firm without impact on its investment excellence approach. How have you been able to achieve that?
You're right. It's been an unbelievable ride. And I think it's really underpinned by a culture that we care a lot about. And I know a lot of firms say this, but I think at the heart of our culture, we believe, of course, in digitization and the globalization we spoke about. But I would tell you, within our people, we want people that are entrepreneurial. We want people that are collaborative and have a partnership spirit. And we want people that fundamentally believe that this is a platform where they can deliver better returns for their investors. So the concept of investment excellence is embedded in everything we do. And I don't think we would ever grow the firm either in size or in products if we didn't convince ourselves we could deliver investment excellence in those areas. So even though we've grown, ironically, we've kind of grown with our market size or our market set. We haven't grown beyond the normal type of deals GA's always done. We haven't had to go look for other areas of growth. We've just kind of been defending our terrain. And you look at how we've grown into new products, whether it's in our credit product where we have investment excellence, whether it's what we're doing now in real assets and sustainable infrastructure, we have premium performance. And there's a real focus on keeping the investment integrity of each of those platforms and measuring growth to make certain that we don't ever get in the way of premium performance.
What are the sectors that you tend to focus on and why?
I should have mentioned this probably when we spoke about the evolution of private equity, because one of the other evolutions that's happened is clearly the days of the generalists are gone, right? And I think more and more we're driving alpha in a way through company picking, right? And to drive your company picking, that means you need to be as smart as possible and as read in as possible on the themes and the type of industries you're going after. And that's exactly how we've organized our firm now for decades, which is very thematically based. We have a consumer technology and enterprise technology practice, a healthcare practice, consumer practice or consumer goods, a life science practice, and a financial services practice. And everything we do is tied together by technology, right? So every company we back is using technology as a competitive differentiator. But within those sectors, our teams are deeply focused on identifying themes that we think carry growth for a long period of time. And those themes can be, I would tell you, if I had to flash a slide right now with all of the themes, it would fill up the screen because we're constantly churning through themes to identify the next one. Most of the time, they're dead ends, right? You think of a theme these days. There's a lot of talk around crypto. Well, are you going to find the right company, the right growth rates, the right business models? Are they going to be adequate for our brand, and so on? So we churn through them. That helps us identify businesses, but it helps us get really, really smart on the underlying drivers of an industry. And by the way, these themes, once you get to them, they become global themes. It's fascinating when you look at some of the real power rallies where we've delivered consistent outperformance. These are themes that can go on for 10 years and that can globalize themselves with some regionalization. So part of the thematic genius is then you localize it with our local teams. And that's been a really powerful tool. And I'll give the example of digital payments. That is a theme that we've been investing behind now for 15 years. The first digital payment deal was a deal done in Europe, where the thesis was very simple. It was commerce was moving online. Banks didn't know how to process online payments because credit cards weren't present. There was a fraud risk. So a new brand of processors was emerging, and we backed two of them. One was called Global Collect, and one was called Adyen. Adyen became a star of the European technology public markets and a fantastic deal for us. Today, that theme has evolved 15 times over. Now it's about integrated payments into software. And so if you look through our portfolio, you will see a number of deals where they are specifically attacking certain verticals, and they're providing software with a payment stack integrated into it and effectively disrupting the type of companies we invested in 15 years ago. That's the depth of the theme that we go through. And we're seeing activity now almost across all of our themes. I would tell you that the healthcare sector in the US is ripe for disruption through technology. We all know how much is spent in those markets. We all know the inefficiencies there. In some of the emerging markets, it's just access to primary care. So we're seeing a lot happening there. We're still seeing a lot of deal flow through very simple digitization of the small and medium business, right? So software tools around that. We're seeing a lot in financial services as banks get regulated, and some of the financial services are fleeing banks into new service providers. So I would tell you, there are 1,000 themes we're chasing, and they're all generating fantastic deal flow.
Why does GA emphasize minority deals and partnership over control? You touched on this a little bit earlier. And how do you think about alignment and transparency, especially in tough situations regarding human capital?
I would tell you, first of all, we don't really define ourselves as minority-only investors, right? I think that the philosophy we've had is a company first. So first of all, let's identify the best company and the best entrepreneur wherever we can find them. And once we find that great entrepreneur, let's try to find the deal that can get done with that company and that entrepreneur or that CEO. So we don't want to define ourselves either as minority or majority. We want to become investors in the best businesses. That's the starting point to the way we think about it. So if a minority is available, then we'll take that. If we can get a majority, we'll also take that. The flip side of that also is, most of the time when you're doing a minority deal, it's not about buying a company from someone. What we're really doing is partnering with someone. And that is a very different dynamic in the negotiation and the tactics, right? So you will not see us do the same types of deals as the big buyout firms who are buying control, because the relationship they have with the entrepreneur, the CEO, or the existing shareholder is, we're buying your business. What's the price? And the next day I will do what I want. The discussion we have with entrepreneurs is completely different. It's a real deep partnership discussion on, okay, what are your plans? What are your ambitions for your company? Do they match what we think is possible for the business? How do we think we can help that? Is that something you'd be open to? And therefore, how do we strike that partnership? It's a very different diligence process, very different deal-making process, very different everything process, but one that we've gotten really, really good at. I would tell you the one of the biggest upsides of that is our opportunity set is massively bigger because of this flexibility. So few entrepreneurs are at the point of saying, oh yes, I'm selling my whole business. And when they're doing that, usually you should be kind of suspicious. Most of the entrepreneurs really buy into the idea of, if I sell a piece and keep most, I can continue to compound value and do well for myself. So that's been the opportunity set is really exciting around that. On your point around how do we strike the partnership, I think there's a way I think about it is this kind of partnership risk and assessment it's like the poison we've been sipping for 40 years of our existence. And now we've developed tolerance and we know how to deal with it. And which is from the very, very early stage of any discussion we have with an entrepreneur, we make certain that we expose them to as many of our partners as we can. And we make sure that we have every single open conversation about human capital, all the tough stuff, human capital, exit timing, their role, right? The toughest discussion usually with an entrepreneur is, well, what if you're no longer the right person to be CEO? And so we front load that as much as we can, or actually completely in the diligence process, so that once we shake hands to become partners, it's a completely open discussion and open negotiation. Now, nothing ever goes according to plan. So I often get questions from my investors. Well, how do you contract around this? Yeah, of course we have exit rights. Of course we have CEO appointment rights. Of course we have all sorts of governance rights. But I think what's much more powerful is the process we go through and this confidence that we build with entrepreneurs.
What would you say are the key attributes of a great entrepreneur, many of which you've obviously met over the years?
Listen, the first thing the great entrepreneur has is, of course, they have vision. Of course, they have this. I would tell you they have a unique way of assessing risk and return that I'm jealous and sometimes I wish I had. I think when they have strong belief in their business, you can see a drive and a commitment to a strategy that very few have. And that said, the most talented entrepreneurs I've dealt with, some of the things that always wow me is you have a lot of entrepreneurs that lose themselves in 1,000 ideas. You have very few entrepreneurs that are capable of grabbing the one great idea and really delivering on the execution of that. So this capability of making a complex problem into a simple solution is something that always impresses me with the best entrepreneurs. And I've seen that happen. And you can imagine in our portfolio, we have companies growing 50%. We have companies that go from single country to multi-country. We have companies that have to reinvent themselves sometimes. We have companies that are hit by a change of regulation or a change of market environment, whatever it is. And so that ability to change complexity into simplicity is I think, defines some of the great entrepreneurs. And then something I mentioned earlier, I think the really great ones, the ones that scale, the ones that bring a 100 million revenue business to $1 billion, it's because they have an ability to attract unbelievable talent, delegate, and empower people. And I think the flip side of that is those entrepreneurs you see who can't attract talent, that is a huge, huge, huge warning signal for the future of a business. And you see it very clearly. We do a lot of work on the organizational design of our companies during our diligence process. So we'll do management assessments. We'll speak to 3 layers down in the C-suite. If the C-suite is weak and somehow you have a feeling the entrepreneur is great, that's not a great sign. When you see an entrepreneur that might have some shortcomings, but is able to build a world-class team, that is usually a great leading indicator to performance and success.
And I suppose a big part of that simplicity factor that you described is just a clear vision of what they're trying to achieve and being able to communicate that across a team. And it allows everybody in the company to row in the same direction and become much more efficient in that regard.
100%. That's very well said. It's exactly the way we see it. We see it happen is we have genius entrepreneurs who will go to their team and say, well, here are the 14 priorities. And then your team lacks focus and consensus. What is amazing is when someone says, listen, here's the 2 opportunities that truly can be transformational for our company. We need everyone to align. And they drive that alignment. That's exactly the type of simplicity that is, I think, a defining character.
How do you compare the landscape and innovation cycles in Europe versus the US, especially regarding valuations and tech talent?
So I'm a proud European, so I will always defend Europe as a wonderful market to invest, even in technology and growth. But listen, the facts are not great for Europe, right? And one of the facts I love talking to my investors about is if you look at the economic weight of the European bloc versus the US before the financial crisis of 2008, we were almost the same size, including the UK. So forget about Brexit. If you look today, we're more than 40% smaller. And if you double click on what happened, it's not about fiscal incentives. It's not about the capital markets. It's not about demographics. It's not about any of that. It's actually purely GDP per capita, which tells you it's all about productivity. And productivity is because there's been much more innovation in the US than there has been in Europe. And frankly, a lot of the digital champions of Europe are US companies, right? Search is Google and the cloud computing stack is all US providers and so on and so forth. So I think Europe has some catching up to do in terms of the innovation cycle. But I would tell you the last probably decade, we've seen fantastic innovation happen across Europe. And that's evident and apparent in the size of our portfolio, right? So a 25 or $22 billion portfolio in European technology, growing at north of 30% and delivering great performance tells you that there is innovation happening in our markets because one, talent is here. So absolutely, you will find the same quality talent underlying across all of our markets, whether it's the UK, France, Germany, Italy, so on. There is an enormous amount of talent, and talent is starting to gravitate more towards entrepreneurial jobs than the more traditional jobs. So we see tons of momentum there. I think where Europe continues to struggle a little bit is access to capital and higher borders, right? Yes, you hear a lot about over legislation of the market. That's true. It is hard. People talk about Europe as a single block. That's not the case if you speak to an entrepreneur. Growing your company from France to Italy, even if there's a lot of cultural similarities, is very hard work. Different everything, different regulatory processes, different everything. Same, even more if you're going north, right? So it still is harder to grow. And then access to capital, what I mean by that is the venture community is smaller than the US community. It's a little bit less ambitious in its scale. The growth community is smaller than the one in the US. And then the public markets are frankly not supportive of technology companies. It's a really sad statement to look at the FTSE, the DAX, or or Euronext technologies under 5% represented in all of those indices, right? These are indices of the past rather than indices of the future. And so I think we need to go through a little bit of a transformation of ambition in Europe, which is we've got the talent. We obviously still have a large market to address. We just need to give them the right tools to continue to grow their businesses and not be kind of ashamed of being European in an odd way. Now, to your point on valuation, the flip side of that is because the perception of our market is a little bit less exciting or dynamic than other markets. It means there's a little bit less competition for us as growth investors. It means valuations are typically slightly more appealing. It means processes are easier to manage. And I think that's also why we're so excited about the opportunity set here.
And what about the Middle East and Africa? What do you see the most compelling opportunities and also the biggest risks for growth?
Yeah, the Middle East has been an eye-opening market for me because when you look at it, there's so many strong fundamentals behind it. Of course, it's a very young population. It's completely digital. You look at 5G penetration, smartphone penetration, it's at 100 and something percent. It's a rich population, right? GDP per capita is very strong, in particular in the Middle East. And all those dynamics are great for the kind of digital innovation we want to back. What we typically see is when those trends start, you have a venture community that shows up and pushes companies from product concept risk and development risk to get it really to where we get involved, which is execution risk once the product has proven itself and has a go-to-market strategy and customers. And that's kind of where the Middle East is today. We're seeing the venture community made some good headwinds, I'd say, during the period of 2020, 2021. I think it was a little bit of a crazy market. People overpaid for stuff like everywhere else. But that's left us now with a landscape where we've got very healthy entrepreneurship and opportunity set in a fairly large market. So some of the recent transactions we did, I'll give you a sense, is we bought into a fragrance brand called Caillaux. It's a Dubai-based and born company. It's selling completely globally through Sephora. It's growing north of 50%. It is winning a global customer base, yet it's born through an entrepreneur in Dubai. We did the same with a Warby Parker type equivalent across the whole region. And so you're seeing similar trends that we saw in other markets. It's still earlier days, but we're seeing something fascinating happen in that market. It seems like the UAE and Saudi are attracting most talent. I think if you had to give a nod to how people have managed their countries, I think Abu Dhabi and Dubai do a wonderful job at attracting corporates and talent and capital. So we're seeing a lot of entrepreneurship happening there.
How does GA structure value creation and risk management differently across regions?
Listen, every market has a ton of variance and variability, right? And part of what we do, I mentioned this earlier, is we're incredibly entrepreneurial in the way we let our teams on the ground think of the best risk return in their own market, right? So I think it's a mistake to think that you can, from a center, whether it's in the UK or the US, dictate what are the best themes and the best investment opportunities in name the market, right? So at the heart of the way we manage our investment program is every region is empowered to find the best within their market, when they're within their opportunity set. Of course, following the guidelines of our investment themes and so on, but they need to be focused on that. The way we then add value is incredibly scalable across different markets. The challenges of an entrepreneur, whether he's based in Europe or based in Singapore, are very similar. They're always anchored around talent management. They're always anchored around technology scalability. They're always anchored around building their go-to-market strategy and product development. And there we can really benefit from best practice across all of our portfolio. I think what's a new overlay that if you've been having this talk with me 10 years ago, I would have said doesn't worry us much is this geopolitical overlay. I think that's something that, of course, is growing in importance. But at the heart of it, the value creation and the way we think of risk return is very similar.
How are consolidation and industry trends shaping the PE landscape today?
We spoke about it a bit earlier. I think the trends that are happening in PE are not dissimilar to what we've seen in other financial services markets. I mean, banks went through it 20 years ago. Hedge funds went through it more recently. And you see it with the audit firms and some of the law firms, where I think you've got to commit yourself to growth if you want to continue to be relevant and vibrant as a private equity partnership. And we think our perception and our vision here is to continue to be one of those winning platforms. Within that means you need to have the resources and the scale to be relevant and have the right brand for entrepreneurs, right? You need your entrepreneurs to want to accept your capital. So do you have the scale? Do you have the tools? Do you have the brand for entrepreneurs to want you as an investor? You need to have the scale and the capital to attract the best investors within your teams, right? So if I don't have the tools, maybe I can't hire the next bright investor, and that's what's going to drive my business forward. So I think those dynamics are pushing for a little bit of a push towards scale. I think there's a lot written around how some of the very large platforms are giving up on investment excellence. I think there's a way of growing without giving up on investment excellence. And I think there's a way of growing where you continue to have a vibrant partnership and continue to have a brand that represents the core values of your investment program. But I think over time, I think you'll see some consolidation happen in private equity. I think you will see some undifferentiated firms disappear or struggle to raise capital. And I think you'll see some winners emerge within their sectors.
Climate tech has been a pretty big topic lately. What catalyzed GA's conviction in climate tech as a multi-decade investment theme?
So we always built, if you look at the way General Atlantic has built its growth equity program, it's always been thematically focused, as we spoke about earlier. And we've grown our program really by adding themes within a growth equity strategy, right? So we were a tech firm. We then added a financial services theme. That's been a 20-year franchise. And we kept going. We added consumer about 10 years ago. That's become a new great franchise. 5 years ago, we started seeing a significant tailwind that was driven by energy transition and the push towards a more sustainable economy globally, right? And what we realized then is we started looking, there's a lot of estimates on how much capital is needed to make this transition happen and get to net zero, and it's trillions of dollars. What we noticed is a lot of people were attacking the venture side. By the way, I think those will be dreadful returns, but that's a problem we don't have to worry about. There was a lot of people attacking the infrastructure side, right? The building of renewable energy, the building of battery technology, I mean, all that kind of stuff. What we didn't see was a lot of people applying growth equity capability in taking proven technologies and pushing them to scale. And when you look at the need for the transition, yes, it's about renewable power. Yes, it's about new battery technology. Yes, it's about all this kind of stuff. It's also about gaining efficiency. And that's really where we thought we could play a role with our growth equity strategy. So within that, what we did is we launched Beyond Net Zero as a new thematic approach into our growth equity strategy. So it does exactly the same type of investing, exactly the same type of partnership deals, same value creation strategy, same everything as the rest of the growth equity strategy. However, it does it with companies that not only are net zero targeted themselves, but on top of that will specifically measure and target the reduction and avoidance of greenhouse gas emissions globally. And so a simple way of thinking about it is we're trying to find companies that are at that intersection of reducing greenhouse gas emissions, but still being great growth companies with good business models. So a lot of software, a lot of analytics, a lot of data and high-end services. And that's been a fantastic opportunity set for us. We developed a great climate framework. So all of our companies adapt to that. We report it to our LPs. You can see the emission reductions. It's a very powerful tool. And we're also finding a category of businesses that not only are great growth companies in their own self, right? These are great businesses to start with. In addition to that, they actually really care about avoiding emissions. And that's really how we've built this Beyond Net Zero strategy. I think this is put all the noise aside and the lack of commitment by the US on some of the sustainability topics, by the way, which hasn't affected our strategy. That's really affected some of the more infrastructure layers. But put all that noise aside, we think this is a 30-year investment tailwind because of the amount of capital that we need to make this transition happen. And I think if you're grounded about this, we need this transition to happen, and we're very committed to it.
Another hot topic these days is data centers. How do you see this area evolving in response to the growth in AI, cloud, and also the sustainability pressures?
Listen, it's a topic I think is in the press almost every day. And first of all, I'd tell you, this is my fourth technology cycle, and every single one surprises me. This AI cycle, I find, is even more surprising in the speed of its adoption and the amount of capital going behind the opportunity set. So it's been, I think 2 years ago, I would have never predicted we'd be where we are. And even the adoption of ChatGPT in the US on the consumer end, or some of the applications we're seeing on the enterprise end, I think the developments are really extremely exciting, but also a little bit overwhelming in their pace. The data center opportunity, I think we have to ground ourselves a little bit on what's happening, because we should remember data centers right now are about 1.5% of global power demand, right? So it's a tiny part of the grid. And I think the biggest projection is it might double. So it's going to go from 1.5% to maybe 3% if nothing changes. It needs to be built intelligently, and it needs to have an application of technology to make them more efficient. So when I mentioned that we thought data centers would go from 1.5% to 3% of global power demand, within that, please remember that only about 50 to 60% of all power that goes into a data center actually powers the compute. 40% is either wastage or cooling. And I can tell you, we're seeing incredibly exciting technologies that address both of those. So what I hope is going to happen is the 1.5% stays 1.5%, despite all the new gigawatts that are being developed, because we're going to find efficiencies through technology and innovation to go against the growth in data center power demand. We do think there's an opportunity in data centers. We have a data center capability across the developing markets, so outside of the US and Europe. We're not at the stage of building 2 gigawatt data centers for large language models to train themselves. We're really at the stage of just powering the shift to the cloud economy. Those we think deliver incredible risk return for investors. It's emerging market investing, despite everything being dollar denominated. So you make a real premium in the way you get rewarded for that. And there, the trends are obviously incredibly powerful. Just to go back on the sustainability risk around that, I think people see it as 5% of the global emissions. I do think that that's unacceptable. And in a way, as I mentioned, there are so many technologies already in production that are hitting critical scale that can help avoid those emissions. And I think we need to make this the responsibility of not just the hyperscalers, but everyone that's building a data center, all the cloud providers, and actually all the developers. We should have our eye on that.
How is GA leveraging AI, both as an investment opportunity and also as an internal tool for your company?
So AI, as I mentioned before, I think we've all been blown away at the pace of innovation and the number of applications that are being added into the market every day. And I think you're right. We see kind of 3 elements to how we use AI. There's the internal element within GA, and you can imagine we're an incredibly data-rich environment. We have a database of over 100,000 companies in our database. We add more than 10,000 companies a year to our database. By the way, out of those 10,000, we do about 25 deals. So it gives you a sense of the funnel of information that comes through. But the 10,000 is an important number because it helps inform every investment decision we make. And now applying AI to all that data is making us not just intelligent at the moment of underwrite, but also intelligent at the moment of portfolio management, at the moment of risk management. So that's an area we're spending a ton of time on. We already have a decision support tool that helps our investment committee make decisions. That tool has ingested 20 years of investment decisions at GA, and we use it as a tool as an investment committee. It votes on deals. It's not a formal vote in our compliance, but it has a vote, and we look at it very carefully. But more importantly, I would think of it as a tool that helps eliminate certain biases. Because as investors, you always have a bias. And my underlying team have biases. I know that so-and-so who does our enterprise tech typically likes to overpay, but he'll be too confident on margins and he'll always undershoot on growth. And so, this kind of decision tools put that feeling I have about his bias into real numbers and really helps our decision making. On the portfolio side, it's even more powerful because it allows us to compare not just the obvious, how is the company performing against budget, against plan, against this, against that. It also takes all sorts of other data sources, external and internal, and helps us read through as much of the noise as we can and get to the real heart of underlying performance. So that's one bucket. I can tell you also internally, we're using AI now to automate all sorts of tasks around the job of the analyst, around the job of data collection. And that allows us to focus even more time on the higher value add stuff around decision-making and deal structuring. The second area is what do we do with it within our portfolio companies? And as you can imagine, with a portfolio of over 200 technology and services businesses, this is an incredibly exciting set of tools that's being given to us because after years of inflationary pressure, whether that was on wages, on tech cost, on chips, you name it, we've been dealing with inflation on the cost side of our portfolio companies for 10 years. This is the first real deflationary tool we've had for a while. And as a result, within our value creation group that I've spoken about, we now have experts in AI, and we dispatch them within the portfolio companies to make sure that they have the right AI strategies to change their P&L. And the impact has been unbelievable. Not hard, not easy to implement. So I think it takes some time. I'll come back to that in a second. But, in certain areas like obviously software coding and development, so some of the engineering stack, everything that touches consumer interaction, everything that touches CRM, everything that touches editorial content and marketing content, we've seen automation gains and efficiency gains that I think none of us expected. And they're very, very powerful. Now, I said they're hard to implement because you need to have the right data environment. You need to have the right change environment. You need to have the right people. So you see articles of people say, oh God, AI is going to change my business in a year. I don't buy that. I think it's a 2 to 3 year evolution, but it's one that's going to be hugely positive for the technology ecosystem. And then the third part is obviously how do we invest our own investors' capital behind some of the AI evolution and AI opportunity set. And there, I'd say we're still in research and development mode. We've made a few investments. The struggle we still have is you would typically see an investor like us, invest in a point in time where unit economics in a company are stabilized, right? You understand the gross margin profile, you understand the margin profile at scale and the cash flows. What's happening right now in the development of the large language model or even the application layer is there's so much capital chasing these deals that one, values are high, but two, unit economics are a little bit subsidized by overcapitalization. And that's something that we're very cautious about. But you'll see through our portfolio, whether it's an Anthropic on the coding side where we've committed some capital or other businesses, we're starting to see an appealing set of opportunities.
How are quieter public markets impacting portfolio company fundraising, IPOs, or liquidity planning?
The toughest part of our job for the last 4 years has been predicting liquidity. And, a firm like ours, because our portfolio is an appealing growth portfolio, we typically rely on 3 types of exits and now really 4. There's obviously the strategic buyer. So if there's a consolidator in the market, a strategic buyer that comes in and buys your businesses, that ebbs and flows, but is a pretty consistent opportunity for liquidity. The second is later stage investors. So once a company's matured from our type of growth profile to a bit more later stage, then the buyout firms show up or some of the sovereign funds or something like that. The third tool was always the IPO. And, over the last 4 years, technology IPOs have been hard to come by, right? I would tell you in Europe, I don't think we've had many technology IPOs in the last 7 or 8 years. We actually priced a successful IPO last week, so we're really excited about that. But that pool of capital has been very hard to predict and sometimes actually not very fair or rewarding, right? When volatility is high, the long-only investor in an IPO demands massive discounts to what they think fair value is to compensate them for the volatility risk they're taking. So that's been a hard one. What I think has happened since is you've seen the emergence of secondaries markets, continuation vehicles, and so on. Some people find those as an unpopular way of getting liquidity. I still think it's a great way for us to manage liquidity for our LPs because it offers risk transfer, right? You can deliver liquidity for those who want it. If someone wants to keep going, they get to reinvest in the vehicle. And I think that's a part of the market that'll see some growth. In a way, taking a bit of share from the IPO because we simply can't rely on it. Now, that doesn't mean we're giving up on the IPO. We've had a couple great offerings the last few months. We thought this was going to be a big IPO year, and then some of what happened with Liberation Day set the markets back massively. You had volatility spike, impossible to price once VIX is above 40. You just can't price a deal, et cetera, et cetera. The last couple months have been more stable, and so we priced a great IPO in Europe called the Swiss Marketplace Group. That's the first successful tech IPO in Europe for a while. It seems to be trading well. So I would tell you, it's pushed us to innovate a little bit on liquidity channels, but we want the IPO to work, right? We think it's an important part of the capital ecosystem, and we need it to work. So we spent a lot of time worrying about that and trying to help both the exchanges and the regulators think that you've got to create an easier, more simple process for tech companies to list themselves. Because if not, you're starving capital from an industry of growth.
Well, Gabe, you've been very generous with your time. I appreciate you sharing all your insights with our audience. Thank you for joining us.
Thank you so much, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.